Indian markets have been struggling for nearly 18 months now. And just when we thought maybe things are stabilizing, boom, another geopolitical shock. The whole US-Israel-Iran situation. And crude oil is up nearly 50% in just a few months. Recently it spiked even more. At the same time, dollar is getting stronger and stronger and rupee has weakened by over 20% since Russia-Ukraine war started. Now for India, that imports 85% of its crude oil, this is really painful. Like imagine you run a restaurant and most of your ingredients you have to import. Suddenly those ingredient prices shoot up by 50%. And on top of that, the currency you earn loses 20% of its value. Your margins are squeezed from both sides. That's basically what is happening for our economy right now. So obviously the question everyone is asking, what does this mean for Indian sector? Which sectors are getting hammered? And are there any sectors that actually benefit from it? So here's the thing most people don't realize. The impact is not the same everywhere. Some sectors get hit immediately, like bang, right away. Some feel it indirectly through their supply chain. And then there are a few sectors that might actually make money from all this chaos. So let me walk you through both sides. And then I want to share something. This whole situation in last few years has actually made me completely rethink how I am allocating my portfolio. We'll discuss that as well. Alright, let's get started. So which sectors are getting crushed right now? First is aviation. This one is pretty obvious. Fuel is like 40-50% of an airline's operating cost. So think about it like this. Airlines are basically like a taxi service where half of every fare you collect goes straight to the gas station. When crude spike, companies like Indigo are completely exposed. They have no way to protect themselves. The next is oil marketing companies. So you've got Indian Oil Corporation, Bharat Petroleum, Hindustan Petroleum. These guys import crude, refine it, and then sell petrol, diesel and LPG. Now in theory, if crude price goes up, they should just pass it on to the consumer so that margins stay the same. But here is the problem. In India, fuel prices are driven by politics. Inflation is already high and elections are coming. So if government delay price hikes, these oil marketing companies end up absorbing the cost themselves. It's like being a shopkeeper where your supplier charges you more, but you're not allowed to raise prices for your customers. Naturally, your margins get killed. The next is paint companies. Around 35-45% of raw material in paint sector is linked to crude oil derivative. Not just petroleum product, but petrochemical derivatives, solvent, resins, all kind of additives. So when crude spikes, margin on paint companies like Asian Paint, Berger Paint get squeezed. Most people don't even connect paint to oil prices, but the link is very real. Then you have got automobile. This sector gets hit from two sides. First is demand side. When crude price goes up, petrol and diesel prices go up. In that case, many people just postpone buying, especially in the entry level segment. So that results in slowdown in demand. Then second impact is on cost side. A lot of auto components like plastic, synthetic rubber, various polymers all derive from crude. So when crude price rises, material cost goes up. Plus your logistics and transportation cost also goes up. So manufacturers are getting squeezed on margins unless they increase the vehicle price, which then kill the demand even more. That's a vicious cycle. Okay, so that's the bad news. Now who actually makes money when crude rises? It's the companies that produce and sell crude oil. Their selling price goes up, but their production costs stay pretty much the same. These are called upstream oil companies. In India, we have ONGC. But here is where things get interesting for me personally. So I've been monitoring crude price movement and wanted to understand which companies are actually going to benefit from this. And here is what I found. The biggest upstream oil producers, the ones that are really positioned to make massive profit from this volatility, they are not in India. They are in the US. And honestly, it's not even just about oil. It's more about diversification from geopolitical event. So the more I explored how I can reduce my risk and identify investment opportunities, the more I realized that many of the most compelling investment opportunities are not just available on Indian exchanges. And that's when I seriously started looking into US investing. I eventually opened an account through iMoney to actually get access to these markets. And let me show you what I found, because this really opened my eyes. Just look at ExxonMobil, one of the largest integrated oil companies in the world. They do everything from exploration and production to refining, petrochemical, the whole chain. When crude prices rise, their upstream segment becomes super profitable. They're selling oil at higher global prices, but their production cost stay relatively stable. During Russia-Ukraine war energy shock, when crude went above $100 barrel, Exxon reported record earnings, massive cash flows. They were returning huge amount to shareholders via dividend and buybacks. And with this recent oil volatility, the stock prices have been going up. Exactly what you would expect. Then you have got Chevron. Similar model, but they have strong upstream assets in the US shale, Gulf of Mexico, international fields. High crude price boosts their earnings significantly. Again, stock price is moving up. Market is clearly optimistic about sustained higher crude. Then you have got ConocoPhillips. Now this one is interesting because unlike Exxon and Chevron, ConocoPhillips is way more focused on just the upstream side. They are primarily into exploration and production. They don't have big refinery operation. So think of it this way. Exxon and Chevron are like diversified businesses where only one division really benefits from high crude. ConocoPhillips is a pure play. The entire company's revenue directly depend on crude prices. So when oil goes up, their earning typically grows even more sharply. And stock price has already shown strong upside. Okay, let me be very clear. Crude oil is volatile. So upstream oil producers can be a momentum play. And you need to be comfortable with that volatility. But here is what really changed my perspective on the whole thing. It's not about the oil. US market gives you access to some of the most innovative companies in the world. And right now, we are entering this whole new phase of AI. This is becoming really important. Let's just be honest here. It is still behind the AI ecosystem. We have got great talent, amazing IT companies, but the core AI innovation, that is the platform, the chips, that's all happening in the US. Nvidia, Microsoft, Google, Amazon, OpenAI, all these companies are literally driving the AI innovation. And if you want to participate as an investor, you need access to US market. You just can't get this exposure through Indian exchange alone. And here is another thing nobody really talks about, the currency angle. Look at the historical trend. 20 years ago, dollar was about 45 rupee. Today, it is about 90 rupee. That's more than double. So when you invest in dollar denominated assets, you're getting returns from two sources. One, the growth of those companies, and second is the rupee depreciation against the dollar over time. Just think about it. Even if a US stock stays completely flat in dollar term, you're still making money in rupee term if the rupee weakens. It's an automatic benefit that just keeps compounding over time. And then there is risk management piece. With everything happening in the world right now, I'm totally convinced that you need country level diversification. It's not optional anymore. If something goes wrong with the Indian economy, like a policy shock, geopolitical issue or whatever, in that case, having global exposure means your entire portfolio is not just tied to one country. It's the same logic as sector diversification. You would not put all your money in one sector, right? So why put all that money in one country? The crude oil story, what I showed you today, that's just one example where global markets offer opportunities that simply don't exist in India. But beyond that, it's really about positioning yourself for where the world is heading, not just where it is today. And honestly, the whole process has become surprisingly easy now. With ID Money, account opening is digital, KYC happens online, and it's completed in just 10-15 minutes. Then another great part of US investing is fractional ownership. Stocks like Tesla, Apple, Nvidia cost anywhere between 15,000 to 45,000 for one share. Obviously, that's a lot of money. But thanks to fractional ownership in the US, you can buy these stocks for as low as 100 rupee. Now, some of you might be thinking, all this sounds good, but I don't know how to pick individual US stock. What if I pick the wrong company? Fair point. And honestly, you don't have to pick individual stocks at all. You can simply invest in US ETF, that is, exchange traded funds. Think of ETFs like mutual fund, but they trade on the stock exchange. So for example, there's an ETF called SPY, SPY, that tracks S&P 500. You buy 1 unit of SPY, you're basically investing in top 500 US companies in one go. Apple, Microsoft, Nvidia, Amazon, everything. Instant diversification. You even have the option of starting an SIP in a US ETF or US stock with just rupees 500. Then there are ETFs for technology, healthcare, energy, literally any sector you want exposure to. You don't need to research individual companies. Just pick the sector or index you believe in. Finally, let me also clarify one very important part of US investing, that is taxation. Everyone gets scared about US stock taxation. The most common argument is, it's too complex, I don't know how to file. I had the same worry initially. But it turns out, ID Money automatically generates your tax report. Like the entire capital gain calculation, dividend income, everything. You just download the report and use it for your ITR filing. It's already in the format you need. Actually, one thing I really liked is that everything stays in one place. Your portfolio tracking, real-time prices in both dollar and rupee, even the currency conversion is handled automatically. You are not juggling multiple platforms trying to figure out your actual return in rupee terms. Anyways, that's my take. Let me know what you think in the comment. And for investment in US market, you can explore IND Money, link I provided in the pinned comment. If you find this video useful, do share it within your circle. I'll see you next video. Till then, take care.